I'd like to see a cut in the Fed rate because that should have happened a long time ago. I think they're being very tardy in not doing it and not having done it sooner. They raised too quickly, and I've been quite vocal on that. They also did quantitative tightening, which was ridiculous. And so, and despite that, if you look, I guess you could call it normalized, but if you look, our economy is doing fantastically. And if you take a look at the previous administration, they weren't paying interest. They had no interest rates. They had loosening, not tightening. And frankly, it's a big difference. And our economy is incredible. Our jobs, you look at the jobs market, but you have to be proactive. And so we really need a Fed cut rate.
Be a great buy.
President Trump taking another opportunity to blast the Fed and Chairman Powell for not moving fast enough to lower interest rates. This comes as Fed officials get ready to gather at the annual Jackson Hole Economic Policy Symposium. So joining us right now to talk about the Fed's next move is Nellie Liang. She's Brookings Hutchins Center on Fiscal and Monetary Policy member. Vince Reinhart, who's with Mellon, he's the chief economist there, and CNBC's very own Rick Santelli. All right, folks, let's try and figure this out. We're looking at a great economy or not, especially when you continue to hear such strong numbers from companies like Target and Lowe's today, quickly following on Home Depot and Walmart, what we'd heard earlier from them. Vince, I start with you. What kind of economy do we have?
We have one that is slowing somewhat, but still has a lot of momentum. Resource use is pretty taut, and we're seeing a little upward pressure on costs. The bottom line is we couldn't keep growing at 3% like last year, or else we put too many pressures on resources. So we're slowing to something more sustainable. We are doing better than most of our trading partners.
Rick, you think we're slowing to the point that we need another 100 basis points cut from the Fed?
Oh, my God, no. As a matter of fact, maybe people in the administration that are badgering the Fed a bit, and I do my own fair share of badgering, but not on this topic. Consider the European, the German yield curve. Hey, it's not inverted. They have a minus 91 2-year and a minus 67 10, minus 12.30. See, life is great. You don't have to have that inverted curve argument that we're going in recession. They have interest rates low. They're probably going lower. They like to buy everything in sight like the Bank of Japan. Do we really want to switch economies with Europe? I just think that this notion of continuing this feedback loop of being afraid of interest rates dropping, as many investors are, I referenced the stock market behavior over the last several plus weeks, and, of course, what's going on with the central banks that are racing to lower rates to keep that spiral going. I don't see any good coming of it, and I think that we need to prioritize, we being the central banks and particularly the Fed. If raising prices is worth sabotaging the economy and joining the flush of negative interest rates, that just doesn't seem very logical to me.
Nellie, what do you think?
So I don't think the Fed needs to cut rates to the extent that the politicians are expressing. The economy is strong. There are some headwinds. The economy's it's been fantastic. The amount of labor that has been on the fringes coming into the market and starting to be productive parts of society. The monetary policy could cut rates to support the economy, but it doesn't solve the underlying issues that are currently facing the economy. So not 100 basis points, but it wouldn't surprise me if the Fed were to cut in gradual amounts over the next few meetings.
Hey, Vince, let's talk more broadly, not just about what the Fed could or should do, but also, do you need something like a payroll tax cut at a moment like this?
I think the president should turn around and look at the budget deficit as well. We've got $1 trillion deficits for the next couple of years. At some point, it would be probably more productive to organize our fiscal finances rather than just try to figure out however you can spend or cut taxes within the limits of executive action. It's not going to happen, obviously, in a run-up to an election, but at some point we're going to have to think hard about our fiscal finances.
So think hard, and what do you think it would mean if we are kind of piling everything right now? Vince, I'll start with you, but I'd like to ask everybody this. If we do double down, do something like a payroll tax cut, potentially do a tax cut for capital gains, so it's indexed to inflation. If you do things like that, if you look for big cuts from the Federal Reserve, what does that mean? Does that hurt us down the road if there's really a downturn and we have nothing left to fight it with?
So it's two parts. Number one is it hurts us down the road because we will have accumulated more debt in a willy-nilly fashion that didn't think about the longer term financing of the U.S. It also does erode the Federal Reserve's position in the sense that rates are lower and they have less room to go down. But monetary policy does have tools. They'll just keep cutting even if they have to go, sorry, Rick, into negative territory, even if they have to expand their balance sheet. I don't think we're there. We're not close to there. We are the best performing economy across the advanced economies. It's uncomfortable to be so because it tends to appreciate our exchange rate. But we're better off being the best performer among the group.